Hi, everybody. Good morning and welcome to Dollars with Sense. My name is Terence Vanderwood.
And I'm Ela Lange. We are your two financial gurus for the next 30 minutes. The topic today we'll be discussing is the money tree.
So, what we're going to be showing you is how to grow money like it is on a tree. And people say money doesn't grow on trees, and it's true. That money literally doesn't grow on trees. But there are three different ways that money can make money. And Ella, can you tell me what those three things are?
Of course, money makes money through interest, capital gains, and dividends. But we're not going to be discussing that today in detail. Rather, we'll be talking about what we're going to be discussing a real life scenario of a family of four and how they utilized whole life insurance for their children's money tree. This helped them save for education for their kids and also gave them peace of mind for the long-term insurance needs for their children and grandchildren.
Again, this is going to be a real life scenario where John and Morgan, the parents, use whole life to help fund their children, whose names are Willow and Jaden, a boy and a girl and boy, Willow and Jaden, and help fund their post-secondary education, and also give John and Morgan some peace of mind protection for Willow and Jaden.
Those are two very lovely names, by the way. When we come back, we will discuss further into the details and descriptions of what a participating whole life policy is, the power that is behind it both from a wealth-generating perspective and how it ensures that your child, no matter what happens to them in their future lifetime, they will always have some life insurance protection.
Welcome back to Dollars with Sense. My name is Terence Vanderwood, and I'm here with my co-host, Ela Lange, and we're on the topic of the money tree, otherwise known in the industry as a participating whole life insurance policy.
Now, you may be wondering, why would I need insurance for my child? They're very young. They don't have any need to be insured. And that's a very common understanding of the majority of people. But like anything that is to do with growing and protecting wealth, time is the multiplying factor. The real-life scenario we're going to be talking about with the Simon family will demonstrate the main benefits of having permanent life insurance on your children. So these two main reasons for this type of life insurance for children is, one, in most cases, they are the most healthy they will ever be, and two, insurance costs are less the younger you are.
Yes, so let's talk about the first main benefit. Your child is the healthiest they will ever be. A permanent life insurance policy is very different from the term policy most of you know quite well. The term policy is mostly used to cover big liabilities like your mortgage, for instance. These term insurances are much like renting a house. Each month you pay a premium or a cost, and unless you have an event, you will not see that money again. But you do have the peace of mind. Permanent insurance is like owning. The monthly fees you pay go towards your house, or AKA the insurance policy, and a portion of those funds are then placed into what is known as a cash surrender value, much like equity in a home. There are a couple components to the CSV, which we will get into a little bit later.
Permanent insurance is, as the name suggests, it's a permanent insurance on the life of the person insured. This means that no matter what happens to your child, they will always have this insurance in place. A properly set up participating whole life insurance will also allow your children, by up to the age of 50, to increase their life insurance without having to go through underwriting. This is the process where your vitals, blood, and urine are tested for all potential health risks of the insured person. So that means that no matter what Willow and Jaden, John and Morgan's children, have had happen to them for the first half of their lives, the life insurance company will always assume their health is as fresh and clean as the age the insurance policy came in force.
I think there is great peace of mind knowing that my children will be protected and not have to be denied the ability to have peace of mind for their loved ones. This means that no matter what choices Willow and Jaden make, both good and bad, they will have coverage. For example, it could be that Willow develops diabetes, which can be managed, but then it does mean that she is most likely not insurable ever again. And Jaden could decide to become a scuba diver instructor, and that means that he will also not be able to be insurable.
The number 2 reason why it makes sense to have permanent life insurance on children is because it is the least expensive it will ever be. Permanent life insurance has a guaranteed premium or cost that is part of a contract. The policy owner is responsible for the monthly or annual premium, and the insurance company contractually cannot change the premiums. In the case of Willow, she was insured at 2 years old for a final benefit of $93,000, which cost John and Morgan, the policy owners, $100 per month. Willow is now approaching the age of post-secondary school, and John and Morgan have the ability to use up to $28,000 for her education.
All for the same amount of money, or less, that all Canadian parents receive from the Universal Child Care Benefit. So when we come back to today's edition of Dollars with Sense, we will dig further into the details of the Simons family, John, Morgan, Willow, and Jaden, and how their whole life insurance policies are structured to protect and grow their wealth for the near future and well beyond, with the Money Tree.
Welcome back, everyone, to today's topic, the Money Tree, where we are exploring using participating whole life insurance to grow your money for your child's education while giving peace of mind to you, the parent, to protect your child in their future and for their loved ones. We're going into more of the details now around the Simons family and how whole life has created a sound future for them and their kids.
That's right, Ella. We have John, who is 52, who's the father, Morgan, the mother, who is 48, with their 2 children, Willow, who is 22, and Jaden is 19, and that's as of today. So John and Morgan received some great advice 20 years ago when they decided to place a permanent life insurance policy on both their kids. Willow was 2 years old when they started hers, and Jaden was 1 month old when they started his. With Willow, they decided to put $100 per month towards her whole life policy and $200 towards RESPs, which we've spoke about in previous episodes. With Jaden, they decided to forego the RESP altogether and put the whole $300 per month towards a permanent insurance policy for him.
Now, so this is what the numbers look like today. Jaden, at 19, has a cash surrender value of $34,000, a total policy loan value of $80,000, and a final benefit of $631,000. Willow, at 22, has a cash surrender value of $11,000, a total policy loan value of $28,000, and a final benefit of $194,000.
John and Morgan, the parents and the owners of the policy, are the ones who can determine the best ways to utilize the money, which we'll get to in a moment.
Now that we're discussing this topic today as a strategy around how to meet the education needs of your children, right? So the aspect that beats the RESP every time is that there are no restrictions on what you can spend your money on. The cash surrender value you have available to you is exactly that, cash. And as we mentioned before, the other real advantage is that you have time, which is your most important partner for growing your wealth.
Let's break from the script here, and let's give the listeners what it would look like if John and Morgan decided that they want to reserve this cash for Willow and Jaden's retirement at 55 years old. So instead of using the policy towards education savings, they want to use it to make sure that their kids are taken care of for retirement.
Okay, and that, let me punch those numbers in. Jaden at 55 has a cash surrender value, so we're fast forwarding to when Jaden is 55. He's got a cash surrender value of $547,000 and a total policy loan value of $710,000. And then get this, the final benefit of $1.7 million. Willow at 55, so again, fast forwarding, looking at her numbers, has a cash surrender value of $145,000 and a total policy loan value of $190,000 and a final benefit of $500,000.
That is really incredible, isn't it? I mean, I have referred to this type of idea as a personal pension plan, but the acronym that we so like to use in our industry would be PPP. And that just doesn't have the ring I was looking for. And besides, the money tree is more accurate, as we will explain a little bit further on.
Yes, so there, PPP doesn't really sound very attractive. Yes, so there are 3 different ways to utilize the money that lies within the life insurance policies. Cash surrender value, we talked about it. Policy loan value, what does that mean? And final benefit. So the cash surrender value is the money inside the policy that has been invested by the insurance company. The rate of return on these investments, by the way, is amazingly rock solid. In 2008, for example, the world was seeing up to minus 45% in markets. But these returns, their returns, were up 6.5%.
Yes, and the cash surrender value is available to the policy owner by a simple phone call. For example, let's say Jaden needs to use $5,600 for his tuition. Then John or Morgan would phone the insurance company, ask for a check for $5,600, and it would arrive in the mail a few days later. And that $5,600 would then be minused from the final benefit. The policy loan value is the amount that the insurance company guarantees to pay out in dividends. John and Morgan, as policy owners, can take this figure to an institution, a banking institution, and including this insurance company, and borrow up to 90% of this value. Again, when Jaden is 19 years old, that value is 90% of $80,000.
Really cool. The final benefit is the amount that is paid out on the death of the insured and is paid to the beneficiary. If we look at Jaden's number, $631,000 at 19 years old, John and Morgan can safely assume that he will never have to worry about term insurance for his family, future family, and potentially John and Morgan's grandchildren would also be fully protected if, God forbid, an accident should occur to Jaden.
Really lots to think about. We've thrown a lot of numbers at you there. Make sure that you check us out on Facebook to be able to look at the transcript, and you can see the numbers on there. We're going to take a quick break, and when we return, we will wrap up this week's episode about the money tree and your weekly action item on Dollars with Sense. Welcome back to Dollars with Sense. I'm Terence Vanderwood, and I'm here with Ela Lange. And now we're about to come to the end of our this week's segment on the money tree, and we're going to review this topic. The money tree is also known as officially as the participating whole life insurance policy.
Yes, the money tree is a permanent life insurance that provides a few things: lifetime protection. Permanent means it is with the insured person for the rest of their life, no matter what. Guaranteed basic premiums, it is a legally binding contract between you, the policy owner, and the insurance company. And guaranteed basic death benefit, that's the initial value, what is known as the face value of a policy. And it's guaranteed permanently. I'm just going to add here that one of the ways I've actually funded my own son's permanent life insurance policy is by using the $160 I receive from the UCCB benefit, right? $160. $60 goes towards my son's RESP, And I take the extra $100, the remaining $100, and I have done exactly that. When he was 3 years of age, funded a monthly premium of $100 going towards a life insurance policy, so that either he can use it, the cash values, when he's in his early 20s for whatever purposes, education or otherwise, to start a business, to provide extra help for a down payment of a house. I don't know. But all that to say is, if he doesn't pull that money for his entire life until his retirement, I have set my son up with retirement income. And that makes me feel really, really good.
Yes, definitely. I actually have a couple of policies in force with clients who have thought of it as an excellent way to pass on money to their grandchildren. Usually what happens in the with the estate planning for those who are a little bit older is that they tend to leave everything to their children, but then what they can do is they can also utilize their wealth and pass it along to their grandchildren directly, and be able to also benefit from it from a tax perspective, because anything within inside of an insurance policy actually falls outside of the estate. That's a whole other topic, and we'll get into that later on in another episode. But for now, it's a very, very smart way for either a grandparent or a parent to provide peace of mind for themselves and a benefit to their offsprings or to their heirs. It also provides an opportunity to earn policy owner dividends. The dividends of this policy, of the participating whole life policy, are paid annually, and when they are credited to the policy, they will not drop in value, unlike market investments. They will, however, continue to grow year after year. And the insurance company that we deal with, Canada Life, has not ever missed a year of dividend payouts in its 150-year history.
That's amazing. The other thing I should mention, which I used again, I'm going to go with my own experience, is a 20 pay. So the estate achiever, as we said with Canada Life, that I chose for my son, allows me to pay my premiums for 20 years. After those 20 years, I am off the hook. I don't have to pay for premiums, monthly premiums, after those 20 years. And the policy stays in force well beyond my lifetime to ensure, again, that this policy is in place and in force until my son decides, should he decide to cancel the policy or otherwise. So, lastly, it provides tax advantage cash value growth because it's a dividend payout and it's tax preferred. So, by the way, a permanent whole life policy is also really advantageous to the elderly. I have a number of clients who have a whole life policy in place on their lives so that they can choose to pay their favorite charity instead of the government. It's a strategy that is most powerful way for those who are near the end of life to direct their wealth to their heirs and not to the taxman.
As a matter of fact, this and other similar strategies can possibly do away with your need for a will. But please, everybody, do not let this stop you getting your will updated and in place. That is a very important part of your estate plan. So your action items for this week: 1, pull out that old insurance policy that you haven't seen for years. 2, highlight the contact number of your insurance advisor that is on that statement. 3, contact them and tell them you are interested in a participating whole life insurance policy that has paid up additions. Again, I'll repeat that. A participating whole life insurance policy that has paid up additions. And 4, if you don't have an insurance advisor, then feel free to give us a call. You can either phone us or email us. I think that's it for this week, right, Ella?
That's it for this week, everyone. I hope you guys listen nice and carefully. If you have your questions or would like to provide feedback, you know how to contact us. We are always available on by email, So that's 2financialgurus@gmail.com. The number 2financialgurus@gmail.com, or by telephone 778-879-0820. And of course, our Facebook page, where we are Dollars with Sense and have always these podcasts available for you guys to listen again and again and again.
Yes, that's right. Because on our Facebook page, as Ella said, with Dollars with Sense, we have the transcripts. We also have a YouTube video that you can listen to at your own pace, pause to write down notes if you want to, or you can print up the transcript and read it along with your morning coffee. If you're not up at 8 o'clock with us at KPMG or KPM, what? CKPM. Thank you. Sorry about that, Rod. CKPM. But I'm sure you guys have heard it enough. Anyways, thanks again, everyone, and we look forward to having you next week when we will demystify all the different insurance needs in your entire life. We call it the insurance framework, or how insurance works. And we promise to make it a lively and informative session, just like always.
Have a great week, everyone. This is Dollars with Sense. I'm Ela Lange, and my co-host, Terence Vanderwood. I look forward to speaking to you next week.